Major funding for these broadcasts has been provided by grants from New York Community Bank, AmTrust Title Insurance Company, Perfect Building Maintenance, M&T Bank, Customers Bank, Marks Paneth LLP, Capital One Bank, Collins Building Services, Meridian Capital Group. Additional support has been provided by grants from AKA Hotel Residences Corman Communities, Ariel Property Advisors, Amerant Bank, Bank of America Merrill Lynch, Briarwood Organization, Chase Commercial Mortgage Lending, Chase Commercial Term Lending, Citizens Bank, Dime Community Bank, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties LLC, Handler Real Estate Organization, Hodges Ward Elliott INC, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Casamatides Red Apple Group, Keysight Capital Partners, Matone Group, New Banks, Newmark Knight Frank, Ocean First Bank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Services, Stonehenge NYC, SVN CPEX Real Estate Services, Tierra CRG, the Meringer Family Foundation, and these friends. Today we will continue our discussion with the business executives on the state of the market. My guests include Larissa Belovia, Carrie Palin, Terry Gamola, and Robin Topol. It's very fine to have WebEx, Zoom, and other situations, but it's not the human touch, and it's very difficult to really deal, to get new clients, to discuss business with people. Do you see this remote working taking phase, or is it just a temporary event that people eventually will be going back to their offices?
Well, I think it's going to be bifurcated. I think you're going to have some people who like remote work, people who are more tech oriented and less business development oriented. I think those people will probably continue to do remote work as long as their companies will allow them to. I think in other cases, you have a company culture, you have the interaction among people, you have the need to run into people or see people or have an impromptu meeting. And I think once the virus is under management and control, I think people will, for the most part, will want to come back to work and go back to meetings and go back to in-person lunches and stop the Zooms, or do the Zooms only when it's far away or less easy to meet in person.
I think it's very difficult to negotiate a deal over Zoom. When we were talking about co-working, and it was a topic of discussion. And so what's the view from all sides? Because we have different people from different sides, especially Larissa, who's in the acquisition mode. Okay, when you're buying a building, how do you look previously to COVID at co-working, and how do you look at it today?
Sure. Well, I think even pre-COVID, obviously, we were concerned about some of the credit worthiness of WeWork and the like. And regardless of that, there were some locations that WeWorking was working in, so to speak, and they were valuable buildings and they were good brick and mortar that you wanted to own regardless. I think it all comes down to underwriting. You're going to underwrite a vacate, or you're going to underwrite your building in a way that still makes sense for the target return that you have for it. If that co-working tenant is no longer there. Obviously co-working will need to be reimagined because nobody wants to share a hot desk anymore or kind of shared amenities. This is definitely a sector that will experience some changes.
Right. I think we've seen in the last crises, right, that co-working does not work in a down cycle. I mean, I think it's evident because people can work from home or work from Starbucks. You know, going back to the question before, I think right, co-working is not it serves a really great purpose, right? If you're a startup firm, if you need flex space, that's a great idea, and buildings can offer that amenity, but it's not something that should be taking up 10% of New York's real estate. And I think people aren't really surprised that WeWork wasn't worth what you know, whatever it was, $40 billion. Like, it just wasn't believable, and it became clear way before coronavirus that wasn't a real valuation.
Co-working took up a lot of space that was difficult to lease space in B buildings, often on lower floors, and that was space that had been vacant for quite some time. And so if some of that comes back to the market, the owners of those spaces are going to have a more challenging time leasing it, which is why they leased it to a co-working firm in the first place, because it wasn't getting leased when people had better optionality, better light, better air, wasn't on the third floor and dark. So I think it'll be, this is, you know, still out. I don't know that I want to be in a co-working hotspot either.
We haven't discussed one of the items of the asset classes, which is a major asset class in New York called the residential rental market. Last June, the legislation came into effect, having a, you know, under the stabilized apartments. How do you see the residential rental market in today's world, especially as an investor, as a workout, you know, with collections, tenants not paying their rent and so on, as a favorite asset class? Robin, or anyone who wants to take that?
Well, so far about 85% of residential tenants have been paying their rent. So I think that landlords of multifamily are relieved to see that. Some of them may be supported by the PPP, others may just still have their jobs or be furloughed or receiving rent checks. I think that as the sales for the residential come on, whether it's condos or co-ops, I think that they're going to be softened prices. I think people have learned that they need to get out of the city, or they want to get out of the city, and they can get out of the city. I think that the millennials are now at the stage where if they have a child or two children, they thought they'd always live in the city, they're going to move, whether it's to the suburbs or farther away. They can work remotely, and I think that the New York City residential market will show a short-term, be it 6 months or a year or a couple of years, of softening of prices. New York will always come back, but you don't have foreign buyers right now. Foreigners aren't coming into New York, and I think that the people who may have thought of downsizing from the suburbs and moving into the city are rethinking that. So I think the residential market as a personal investment will go down. As a capital investment, as a class, they're still paying their rent. So I think that people who own multifamily will still be fine.
I agree with Robin on, look, you know, we saw this migration out of, again, like, you know, pre-coronavirus. People were leaving New York City because of SALT, and also because they could work from remotely, right? We weren't all used to Zoom, which is great, but there was, you know, people were doing it, and people were working remotely, and people were dialing in, and people were leaving New York because of the taxes. And so you saw migration, you saw firms were moving to Nashville, to Austin, to North Carolina. And so I don't see that as something that's going to end. In fact, I think that, you know, exactly what Robin said, people are going to move because it's a greater lifestyle to live in the suburbs when you have children, or if what you're looking for is a backyard, right? Living in New York City is a great thing if you want amenities like quick access to Broadway and hop on a subway and go out to a great meal. It's a give and take. But when the amenities in New York City aren't available and you're stuck in an apartment with 3 kids, you think, well, you know, maybe I want to move somewhere else. But again, like, I think you're going to see, you know, New York isn't going to go away, right? Because as soon as the price starts to drop, people are going to move right back in.
Do you see many of your companies, I mean, Robin, your company has offices in other cities. Do you see your companies perhaps moving to Westchester, Jersey City, other parts of the area where the costs are less, where the transportation is different, they don't have to commute into the city? Because the Westchester market has increased over the last couple of months on rentals.
I think some companies will. I think a lot of companies have long-term leases. so they can't quite get out of them. They could perhaps sublease. We're going to see in the next 6 months or so what hits the sublease market. I think that'll be a big factor. I think where companies have the option to move out or to build satellite offices and the workers want it and the workers live there, I think and the price of rent is much cheaper. Once they have that flexibility, I do think you'll have the suburban markets firm up like you did after 9/11. Your suburban markets really firmed up because people said, I'm going to get some of my backup office and some of my workers out of the city. I think the same thing will happen.
Or have you seen new leases being executed over the last couple of months?
Only ones that had been started really early and only ones where there's a corporate need. And what I'm seeing in several cases is they're saying, well, you know what, we're not going to spend this much on the TI, the tenant improvements. We're going to spend less. And the tenants are saying, well, I had done a lease that was pretty far along, and it just, the tenant said, you know what, we'll just squeeze in where we are. We're not going to expand to this other space. So I'm seeing deals die. I've seen several deals die right now. I don't see anything new unless somebody has like TikTok, but that's been 6 or 7 months in the making prior to the lease being signed. I think nobody's jumping in the market and taking space right now. And I think people don't know exactly where the market is. They don't know what asking rent should be, whether they're going to be softened or landlords, of course, are hoping that they'll stay the same. And I think tenants all think it's going to come anywhere from 10 to 20, and some are hoping even more percentage lower.
I think one of the challenges with the office market is that when you're dealing with the same challenges you have in an office building in New York, you have in other locations in the suburbs. And in some cases, those buildings are not new and they have not had the same care and attention that so many buildings in New York have been completely renovated down to the slabs with entirely new HVAC systems and stuff like that. I think mass transit is still an issue we need to get figured out. But I also think that when you look to other locations, it may not be the mass transit, may not be the part of it. And when you look to places like Korea, where they did a very extensive study on someone who came down with COVID in a high density environment, they infected a huge percentage of people, like over 70% of the people that were on their half of the floor. That's not going to change whether you're in Manhattan or you're in the suburbs.
Yeah, I think that also some of this there's a lot of naysayers on office in general. I mean, I wouldn't be in that camp. I think some of this is affecting different metros differently. You know, a market like LA, where most people are driving, is going to get back to normal a little bit faster. New York is going to have its challenges. We're New York tough though, right? So I'm in Brooklyn. I'm not leaving Brooklyn. I have a kid. I'm no interest in moving to the suburbs. Sorry, Carrie, but I think there are those people who still want to be in New York, and employers want to attract employees because they want to be in cities. So to me, this is a short-term issue. Everybody said no one's going in a skyscraper after 9/11. Obviously, that's changed, and people forget. I mean, I hate to say, people do. We will get over this. We'll recover, and we'll get back to normal. It just depends when we have a cure.
I think that's great news, right? That we're going to get past this. There is a light at the end of the tunnel. There will be a cure, and then we'll have a new normal. It won't be like this. It may not be exactly what was before, but people will go back to wanting to be in offices, wanting to have that creativity, the collaboration, asking people, stopping people in the hallway and asking them a question about a transaction that you're working on. We don't have that right now, and we're missing it.
So here's the question: Where do you see the greatest opportunities for each one of you and your clients over the next year? Larissa, is it buying buildings at discounts or properties at discounts? Carrie, is it your high net worth individuals looking at a different type of category? Carrie is an advisory. And Robin, what do you suggest? Because people come to you and say, what should we do? It may not be the right time to make a decision, but I don't have my crystal apple right here. But I normally say, where do you see the opportunities? So we're going to start with Robin, then we're going to go to Carrie, Larissa, and then Terry. Robin.
I think the opportunities for tenants who have leases that are expiring or they're willing to do renewals is that I think it's going to be a bit of more of a tenant market for the time being. I think they'll be able to negotiate better with landlords, both office and retail. I think anybody who's folded up their tent and closed up and now wants to reopen in a new situation will have the negotiability. I think they'll be able to get more free rent. I think they'll be able to get a landlord who's happy to have them. And I think there'll be more opportunities on a tenant side.
Carrie.
Look, I think that, with each of these crises, you have to understand sort of what caused it, and then be able to sort of see through the fog. With the great financial crisis, it was a lack of liquidity, and today it's sort of a lack of connectivity and a lack of movement. I think that the opportunities are going to be figuring out new uses, perhaps for shopping centers that have failed. And if you could come in and figure out a better, highest and best use, because so many of them really are in great locations, or it's buying hospitality that just didn't make it, but it really could be. If we don't get to a medical solution soon, there are going to be so many hotels that fail, not because they were bad, but because they can't survive not being open. And those then, if you could buy them at the right time and then ride that wave when they open up, that's an opportunity.
Maybe part of those hotels can be used as dormitories or other type of places.
But those, I think, if they can be dormitories, they will be dormitories. So those aren't going to be the ones that fail. At least I hope not. I don't hope any of them fail, actually. I mean, it would be great, but we are where we are.
I think it really all depends on what the capital is and what your appetite for risk is. The next few quarters will be really an opportunity for all cash buyers to be able to potentially pick off some excellent assets at lower values. There will be sellers that need to sell because they won't be able to refinance, or because their NOI in the building is now lower, and maybe you're capping a lower NOI. So we've been through the longest economic expansion and real estate cycle, and we finally have an opportunity to buy some assets at hopefully lower values. And normally, if the herd is running away, maybe you should run the other direction. So on the value add and opportunistic side, there should maybe be opportunities in a city like New York where, nobody wants to be there. Maybe you can get some great deals across asset classes.
Terry.
Prices are sticky downward. So I'd agree with you, Larissa, when someone really needs to sell, this is a great opportunity. And I'm a big fan of the lifeboat theory of investing, which is that you want to be where other people aren't. Too many people drive down returns. I think I'm going to take a bit of a contrarian view here. I think that the hotel readaptation, I think that's absolutely probably going to be, if we can't get business travel back in a reasonably short period of time, that certainly could be a great opportunity for folks, as with the malls, which are in fantastic locations, but have a lot of legal issues around them sometimes because they've all been subdivided and cross-collateralized, and there's a lot of very sticky stuff there, which could be interesting. And I think that for other folks, one of the things to be looking at in all of this, we're so focused on COVID-19 that we're also missing the big wave of, certainly driven by European investors, on climate change and sustainability. There is a tremendous amount of capital that's coming into the system that is really looking at these issues, because they're not worried about what happens in 5 years. They're worried about what happens on the second reversion. And they're worried that they're going to get left with stranded investments. And, right now it's happening sort of on an ad hoc basis. Oh, you want to finance this hotel in Florida? It's been flooded 3 times. I'm not really interested in being an LP on this. It's going to flood again. It already flooded. So I think that, that's where there's some opportunity, is to look into that market and say what's going on. Because right now everybody's focused on COVID, and that's where we were headed, and that's where we're going to be back to, especially in this environment. It's being taken quite seriously in other places, and discussion is going on things like building, on how much carbon goes into buildings, and how much carbon comes out when you have to take them down and they're being built with fasteners that can be reused. I mean, the discussion is completely different than what's going on here. And I think that it's a real opportunity here over the next 5 or 10 years, and it's going to expand beyond New York.
One last question. Which borough or which region or which area do you see the greatest opportunity? Is it in the Bronx, Brooklyn? It's Harlem and so on. Where do you see the great place that you'd want to live, work, and to be? Robin?
I think Manhattan's always a safe bet. I think Manhattan will never lose its value. I think retail, office, residential, Manhattan is always king. So I think that if you're patient and you can buy it right, you can hold and you can make a fortune in Manhattan. I think the other boroughs, I'll defer to everybody else.
Yeah, I'm with Robin. I mean, while I don't reside in New York City, like to me, like that's a place where maybe your values are going to fall, but they're going to come back, and they always come back stronger than anyone ever expected, and they always come back higher than anyone ever expected. And if you can, just kind of wait out one of these downturns, you're going to be fine. I love New York, so.
Larissa?
Yeah, it depends what asset class you want to invest in. I would say in New York and our tri-state area, like last mile industrial, that's been a hot commodity, and you're going to continue to see maybe ways that we can repurpose some of our older vintage assets around here, and I think that is an interesting asset class. It's expensive though.
Terry?
I was going to say Manhattan, but that just seems so boring. So I'm going to go with Queens.
Okay. So I'd like to thank Robin, Carrie, Terry, Larissa, the team at AmTrust Title, Stephen Napolitano, Senior Executive Vice President, for being here, and we'll be back in a week or so. Thanks again.